Our next guest says the current environment is nothing like 2009, and he would know. It's Blackstone's head of real estate in the Americas, Nadeem Meghji. Blackstone, the largest owner of real estate globally, I believe. Is that right, Nadeem?
We are indeed. Thanks for having me, Leslie.
So we are really excited to have you here because commercial real estate in particular has gotten somewhat of a scarlet letter in the wake of the March banking turmoil that kind of revealed essentially what the balance sheets look like, their exposure to commercial real estate. Do you think that is deserved?
Look, the interesting thing today about the commercial real estate space is there is such a big bifurcation across asset classes. And more than ever, you can't paint the sector with a broad brush. And in many areas of real estate, what we see today is unprecedented strength. I'll give you just one example. Take the industrial business, which today represents 40% of Blackstone's global real estate portfolio. What we see on the ground today is record low vacancy, only 3%. We also see rent growth in the first quarter that was in the high teens. Now, this is driven by e-commerce. This is driven by the onshoring of manufacturing. And it's not just the fundamentals. This results in investor demand for these types of assets. And so if you look at our announcement earlier this week, we announced the sale of a $3 billion portfolio of warehouses to Prologis. And not only was this a terrific outcome for our investors, but it really demonstrates that thoughtful, well-capitalized investors want to own the right assets today in the right sectors. Now, contrast that with office, which is in the headlines. You know, U.S. office today is around 1.5% of our global portfolio, so it's small. But what we see there is real challenges. Vacancy rates that are north of 20% in the U.S., rents are under pressure, values are under pressure. And so more than ever, the thing to understand is where you invest really does matter. And our job as investors is really to understand how technology, demographics, how people live, work, and play, how that impacts hard assets, and then really invest accordingly.
So it's 1.5% of the $585 billion global real estate portfolio that Blackstone has. In 2007, that figure was 60%. So as you look at the challenges in office, has it gotten cheap enough to the point where you would get back in, where you would increase your exposure at this stage, or do you think it's essentially a lost cause?
Look, a little bit of history on how we've looked at the office business. You know, we saw even before COVID that the sector was facing challenges. What we saw was that capital expenditures were actually growing much faster than rents. And so, as you point out, we took office, which was 61% of our business in 2007, and we brought it down to today 1.5%. That's U.S. office. As we look forward, the sector continues to face real challenges. And you know, some of those are for obvious reasons, remote work, now a tech pullback. And while there are certain markets like Miami and Dallas, which are better than San Francisco today, or while newer buildings are better than older buildings, we are quite cautious on the space. And ultimately, you know, we may dip our toe back in, but it will take time, and we're going to be very selective about how we do it.
You think it has the recipe for crisis? Do you see that unfolding? And I mean, we just had these stress tests that looked at pretty some gruesome scenarios.
Yeah, we don't see that. And the reason is a fewfold. First of all, just to contextualize this, people often conflate office with commercial real estate. But the reality is office is less than 20% of U.S. commercial real estate. So that's number one. Number two, heading into this environment, leverage levels were lower than prior cycles. So what we saw was that the average office building was around 55% leveraged, which means that the value would have to go down by more than 45% for a lender, a bank, to actually incur a loss. And then the last piece of the equation is that bank balance sheets today only have an average 3% exposure to office. So not to say it won't be painful for office, it will, but we don't see it as being systemic.